stock market sounds complicated, right? But here's the truth. The basics of the stock market can be easily explained. By the end of this video, you'll understand what stocks actually are, how the market works, how people make money, and whether you should even invest in the first place. And I promise, no confusing financial speak. If I use a term you don't know, I'll explain it immediately. Let's start from the very beginning. First question, what even is a stock? A stock is a tiny piece of ownership in a company. That's it. When you buy one share of Apple stock, you literally own a tiny piece of Apple. You become a part owner of the company. Let's say I start a pizza company called Dave's Pizza. I decide to divide my company into 1,000 equal pieces, or shares. If you buy 10 shares, you own 1% of Dave's Pizza. So why do companies do this? Why give away ownership? Simple, to raise money. This is why companies go public. They sell shares to the public to raise money for growth. Stock prices change every second based on what people are willing to pay. It's just supply and demand. If lots of people want to buy Apple stock, the price goes up. If lots of people want to sell, the price goes down. So what's the stock market? Think of it like eBay or Amazon, but for stocks. It's a place where people buy and sell shares of companies. The biggest stock market in the US is the New York Stock Exchange, or NYSE. Another big one is the NASDAQ. These are just organized places where buying and selling happens. Here's how it works in practice. Let's say you want to buy 10 shares of Tesla. Step 1, you open an account with a broker. Think Fidelity, Robinhood, or Schwab. Step 2, you put money in your account, let's say $2,000. Step 3, you search for Tesla and click buy 10 shares. Step 4, the broker finds someone willing to sell 10 shares at the current price, makes the trade, and boom, you now own 10 shares of Tesla. The whole process takes seconds. Every company has a ticker symbol, a short code. Apple is AAPL, Microsoft is MSFT, Amazon is AMZN. This is just shorthand so you don't have to type out the full company name every time. Okay, so you understand what stocks are and where they're bought and sold. Now the important question, how do people actually make money? There are two main ways. The stock price goes up and the company pays you dividends. Capital gains is just a fancy way of saying you sold for more than you bought. Example, you buy 10 shares of Microsoft at $300 each, you spend $3,000 total. 2 years later, Microsoft is trading at $400 per share. You sell all 10 shares for $4,000, you made $1,000 profit. That's a capital gain. Dividends are different. Some companies share their profits directly with shareholders. They literally send you cash, usually every 3 months. Not all companies pay dividends. Here's the key insight. Historically, the stock market goes up over long periods of time. The S&P 500 has returned about 10% per year on average over the past 50 years. This is why people invest for retirement. If you put money in the market and leave it for 20, 30 years, history suggests you'll end up with significantly more than you started with. Quick distinction that's super important for beginners. Individual stocks. You buy shares of one specific company. Index funds. You buy a tiny piece of hundreds or thousands of companies all at once. Most experts recommend beginners start with index funds because they're automatically diversified. You're not betting on one company, you're betting on the entire market. Speaking of diversification, this just means don't put all your eggs in one basket. If you put all your money into one stock and that company goes bankrupt, you lose everything. Bull market. Stock prices are going up. Everyone's optimistic. Bear market, stock prices are going down. Everyone's pessimistic. That's it. They're just labels for market conditions. Volatility just means how much prices swing up and down. High volatility, lots of big price swings. Low volatility, stable, steady prices. This is why investing is for long-term money. Last concept, risk and return are connected. Generally, higher potential returns come with higher risk. You can't eliminate risk, but you can manage it through diversification and time in the market. Myth. You can literally start investing with $10 now. Many brokers have no minimum account balance, and you can buy fractional shares. Don't wait until you have $10,000 saved. Start with $50, $100, whatever you can afford. Not true. Gambling is random chance. Investing is buying ownership in real businesses that produce real products and make real profits. Over long periods, they tend to track the actual value and profits of companies. Absolutely not. In fact, checking too often usually leads to worse returns because you make emotional decisions. Studies show the best investors are often people who set up their portfolio and barely look at it. This is the big one. People think they can predict when to buy low and sell high. Even professionals can't do this consistently. The saying goes, time in the market beats timing the market. So should you invest in the stock market? Here's my honest answer. Invest if you have high interest debt paid off, you have an emergency fund, you won't need this money for at least 5 years, and you're willing to learn and stay disciplined. If you're ready to start, here's the simplest possible approach. 1. Open a brokerage account. 2. Invest in a low-cost S&P 500 index fund. 3. Add money regularly and don't touch it for years. That's it. You don't need to pick stocks, follow news, or do anything fancy. This basic strategy beats most professional investors over time. Let's recap what we covered. Stocks are pieces of ownership in companies. The stock market is where stocks are bought and sold. You make money through price increases or dividends. Index funds are safer than individual stocks for beginners. Diversification reduces risk. Time in the market is key. Invest for the long term. The stock market isn't as complicated as it seems. At its core, it's just buying ownership in businesses you believe will be worth more in the future. Start simple, stay consistent, think long term. That's the formula that works for most people. Questions? Drop them in the comments. I read every single one and I'll answer. If this was helpful, hit that like button and subscribe for more finance content that actually makes sense. Thanks for watching. And remember, the best time to start investing was 10 years ago. The second best time is today.